The 1970s versus today, the inflation playbook America doesn't want to repeat in the 1970s. America learned a lesson it never wanted to learn, that a country can be rich, powerful, and technologically advanced, and still lose control of something as basic as the price of bread, the cost of fuel, and the value of its own currency. And when that happens, it doesn't feel like an economic cycle. It feels like the ground moving under your feet, because inflation is not just numbers. Inflation is trust, measured in public. It's the moment people stop asking, what does this cost? And start asking, how much will this cost next month? And once that question takes over a society, the economy changes shape. This documentary is about that shift. The 1970s versus today in the inflation playbook America doesn't want to repeat, not as a political argument, not as a headline, but as a system story, how inflation starts, how it becomes persistent, how it breaks confidence, and what it costs to stop it. Because the real danger is not a spike. The real danger is when people stop believing the spike will end. In the early 1970s, the monetary world America had lived inside for decades began to fracture. The post-war system, rules, anchors, assumptions, was already under pressure. And then in October 1973, the oil shock arrived. An embargo and coordinated supply restrictions hit the world's most important industrial economies. And energy prices surged through everything: transport, manufacturing, food, housing, logistics. At first, it looked like a temporary emergency. Long lines, short tempers, a sudden awareness that modern life runs on a fuel most people never think about until it disappears. But shocks don't stay in one sector. They move, they propagate, they spread into wages, into contracts, into expectations. And in the 1970s, expectations became the amplifier. Because once workers believe prices will keep climbing, they demand higher pay. Once companies believe costs will keep rising, they raise prices faster. Once lenders believe dollars will buy less next year, they demand higher interest. This is the moment inflation stops being a problem and becomes a feedback loop. And that loop has a name: stagflation, a word that sounds clinical until you live inside it. High inflation, weak growth, rise in unemployment at the same time. The old economic intuition said that shouldn't happen, so the public did what the public always does when the old intuition fails. They looked for someone to blame, but the deeper truth was worse than blame. The deeper truth was that the machine was no longer responding to the usual levers. And for a few years, America tried half measures, sometimes tightening, sometimes easing, trying to cool prices without breaking growth, trying to restore confidence without triggering recession. But inflation does not negotiate. Inflation either breaks or it embeds. By the late 1970s, the mood had shifted. It wasn't just that prices were higher. It was that people felt trapped in a world where prices would keep winning. And that feeling began to show up in a place most people never watched directly: the dollar. In 1978, the dollar entered what can only be described as a credibility crisis, a sustained decline that made supporting the dollar an international issue. This is where the story turns from household pain to system stress. Because the dollar is not only America's currency, it's also one of America's most important export products, a unit the world holds, trades, settles in, and builds contracts around. So when the dollar weakens sharply, it signals something larger than exchange rates. It signals doubt. And in November 1978, the US government announced a dramatic dollar support program, borrowing foreign currencies through swap arrangements and issuing foreign currency denominated securities to defend credibility. This was not normal policy communication. This was currency defense. And it happened for one simple reason: confidence was slipping faster than the institutions could restore it. Now pause here, because this is where today starts to echo the past. Not because the numbers are identical, but because the mechanism is familiar. Energy pressure feeds inflation. Inflation feeds expectations. Expectations pressure interest rates. And rates test the financial system's tolerance for pain. And the question becomes, how much pain can a society accept to stop inflation? In the late 1970s, the answer was more than anyone wanted, but not more than reality demanded. In 1979, inflation accelerated again. The annual CPI inflation rate reached about 11.3% in 1979 and 13.5% in 1980. Those are not abstract figures. That is a world where the price tag is unstable, the paycheck is reactive, and long-term planning becomes guesswork. And when the public lives inside that world long enough, trust doesn't just weaken, it reorganizes. People change how they buy, how they save, how they borrow, how they vote, how they talk. Everything starts revolving around one central idea: protect yourself. And when millions of individuals shift into self-protection mode, the system becomes more fragile. Because cooperation is expensive when trust is low, and an economy is, at its core, a cooperation engine. Now, this is the moment to understand why the playbook became so brutal. Because by mid-1979, incrementalism was no longer enough. America needed a signal strong enough to reset expectations. And that required a different kind of central banker. On August 6, 1979, Paul Volcker became chairman of the Federal Reserve. Volcker's era is often summarized in one phrase: high rates. But that summary misses the real point. The real point is credibility. Volcker understood something the public was beginning to understand too. Inflation is not defeated by clever speeches. Inflation is defeated when people believe the institution will do whatever it takes, even if it hurts. That belief is a weapon, and it is also a gamble. Because whatever it takes has a human cost. Layoffs, bankruptcies, recession, political backlash, fear. So the inflation playbook is always the same dilemma. If you don't act hard enough, inflation persists. If you act hard enough, pure plays suffer. And if you act too late, you need to act even harder. That is the trap. And it is the reason the 1970s still matter, because today many viewers hear inflation and think of a recent surge, a spike that came down. But the deeper question isn't the latest print. The deeper question is whether the system has changed regimes. Because there's a difference between inflation falling and the world returning to the old era, and one of the clearest signals is interest rates. Today's environment has reminded the public of something the post-2010 world made easy to forget. Money has a price. And when that price rises, everything that depends on cheap money gets stress-tested households, companies, governments, markets. So the modern question becomes, are we living through a repeat of the 1970s? Or are we living through a different kind of adjustment where inflation cools, but rates remain higher because the old assumptions are gone? Here is the cleanest way to compare the two eras. In the 1970s, inflation was not just high. It was persistent. It kept returning, and it kept rewriting expectations. Energy shocks didn't just raise gasoline prices, they raised the perceived baseline cost of modern life. And once that baseline rises, every negotiation changes. Wages, rents, credit, taxes, government spending, corporate pricing. The system starts to behave like a machine with a stuck accelerator. Today, the shock sequence was different. Pandemic dislocation, supply bottlenecks, a burst of demand, energy, volatility, geopolitical. But the modern vulnerability is also different. Debt in a highly indebted system, higher rates are not just a tool. They are a force. They roll through balance sheets, they reprice assets, they expose weak cash flows, and they create a new kind of fragility, not only inflation risk, but refinancing risk. That means a central bank today fights inflation while walking across a floor made of glass. And that glass is credit. So if you want the honest comparison, it's this. The 1970s taught America what persistent inflation does to society. Today is teaching the world what persistent higher rates do to systems built on low rates. Different pain, same tension. And that tension creates the same political and psychological temptation to believe there must be a painless fix. There are only trade-offs. Now, before we go further, if you like documentaries that explain the hidden mechanics behind history, inflation, oil, money, and power, subscribe now. This channel is built for long-form, system-level stories like this. Because what happens next in this documentary is not a history lesson. It's the playbook, the sequence the system follows when trust is damaged. Step 1, a shock hits a critical input. In the 1970s, that input was energy. Step 2. Prices rise faster than wages. Step 3. Wages chase prices. Step 4. The currency weakens as confidence erodes and imports become more expensive. Step 5. Lenders demand higher rates. Step 6. Higher rates squeeze growth. Step 7. The public grows angrier because it feels like everyone is losing at once. And when everyone feels like they are losing at once, the political system loses patience. That is where playbooks get dangerous, because public fear creates demand for simple explanations, and simple explanations tend to create bad policy. The 1970s produced a long list of temptations, price controls, temporary fixes, blame narratives, false certainty. But the most seductive temptation was this: to treat inflation as a moral failure instead of a system failure. To argue that if people just behaved better, if companies were less greedy, if workers demanded less, if citizens consumed less, inflation would simply fade. That is a comforting story, and it is incomplete. Because inflation is not only behavior, it is also structure. It is how money, production, energy, and expectations interact. And when the structure shifts, behavior follows. So here's a question I want you to answer. Not as an opinion, but as a diagnostic. When you hear inflation, what do you think is the primary driver? Energy, wages, government spending, corporate pricing, or central bank policy? Drop one word in the comments, just one, and tell me why. Now, the most misunderstood part of the 1970s is this. People remember the pain. They forget the timeline. They forget that the decade was not one single crisis. It was a sequence of linked crises, a system learning slowly and painfully that it had entered a new regime. First, the shock. Then the feedback loop. Then the credibility problem. Then the currency stress. Then the hard reset. And in that sequence, 1978 is a crucial hinge, because 1978 tells you what happens when confidence in the dollar becomes uncertain. The system begins to look for alternatives, not because the world hates America, but because markets hate uncertainty, and uncertainty in money is the most expensive uncertainty there is. So a weakening dollar becomes a signal to everyone. Hedge, diversify, shorten horizons, raise the price of capital, and once capital becomes expensive, growth becomes harder. This is why the 1970s crisis is not merely a story of inflation. It is a story of trust. Trust in currency, trust in institutions, trust in the future, and trust, once damaged, is not repaired by incremental gesture. It is repaired by credible action. Which brings us to the core comparison with today. Today's inflation surge cooled faster than the 1970s experience. But many people still feel economic stress because the rate environment changed. Mortgage costs, credit costs, refinancing, risk premiums. So even when inflation prints lower, the public can still feel squeezed. And that creates confusion. How can inflation be coming down if everything still feels expensive? The answer is time. Prices can stop rising rapidly and still remain high. And high prices, combined with high rates, create a different kind of pressure. Not the pressure of runaway inflation, but the pressure of restricted oxygen. So here's the second diagnostic question. Do you think the bigger risk now is a return of inflation or a system slowdown caused by the cost of money? Comment, inflation returns or slowdown, and tell me what indicator would convince you. Now, the final part of the playbook, when a society faces inflation, it eventually learns a hard truth. You can't talk your way out of a pricing problem. You can only do two things: increase supply or reduce demand. Energy shocks reduce supply, and rate hikes reduce demand. That is why the central bank's tool is blunt. It doesn't create oil. It doesn't build factories. It doesn't fix ports. It slows spending. And when spending slows, investment slows, hiring slows, and risk appetite collapses. That is the cost of credibility, and it is why the 1970s resolution created such a powerful cultural scar, because the cure felt like punishment. But the alternative felt worse, a world where money itself was unstable. So if you want the clean lesson of the 1970s, it's this: Inflation is a social and institutional crisis disguised as a pricing problem. And the longer it lasts, the more it rewires behavior. That is why America doesn't want to repeat it, not because the 1970s were embarrassing, because the 1970s showed what happens when a modern society loses faith in its own unit of account. Now, one last layer, the layer that turns this from history into guidance. If the 1970s are not literally repeating, what should you watch? Not headlines, mechanisms. Here are 5 indicators that tell you whether you're in a 70s-like regime or a post-spike higher rate regime. 1. Energy pricing trends, especially sustained, not spiky. 2. Wage growth relative to productivity. 3. Inflation expectations, whether people believe prices will keep rising. 4. The dollar's strength or weakness as confidence shifts. 5. Long-term bond yields, because they reveal what the market believes about the future cost of money. And the simplest question that ties them all together is this: is the system stabilizing or merely pausing? Because a pause feels calm until it ends. So here's the last comment prompt, and I want you to be specific. If you had to pick just one signal to monitor this year: oil prices, wage growth, the dollar, bond yields, or inflation expectations, which one would you choose? And why? Now, let's land the documentary. The 1970s were not a mystery. They were a warning about feedback loops. A shock hit energy. The shock fed inflation. Inflation fed expectations. Expectations pressured the dollar. The dollar pressured rates. Rates pressured growth, and the public demanded a fix. Eventually, the fix arrived, and it was severe. Today, the system is different, but the lesson remains. If inflation becomes persistent, the cure becomes painful. And if rates stay high, the system must adapt or something breaks. So the goal of this channel is not to predict the next crisis. It's to recognize the mechanisms early, to see the playbook before it finishes playing. If you want more documentaries like this, subscribe. Next, we'll break down the hidden mechanics of the dollar itself. How reserve currency demand is built through trade, debt, settlement, and confidence, and why certain decades become turning points. Until then, keep watching the system, not just the headlines.